Dean, let me begin with you. It would seem to me that after this CPI report, this inflation report today, the story is already written. There's going to be a rate cut in September. Has the market already priced that in?
The market has priced in a rate cut in September. The market's really trying to distinguish whether it's going to be 25 or 50 basis points on the size of that rate cut. I think the only thing that could throw it off would be, if we just get a horrible inflation print right before the meeting. But that seems unlikely given the backdrop that we're seeing in the inflation numbers now.
Aadil, it seems that it would be unlikely that the Fed would cut by a half point. That would probably require the next jobs report to be really bad.
Yes. Yeah, most likely we're going to get a 25 basis points rate cut. And I think the Fed has done their job here. CPI came down from 9% all the way down to 3%. The Fed has vanquished inflation. I think that the only concern right now that we see is that consumer spending the earnings report showed signs of the consumer slowing down. So I think that is going to be a concern. So any negative news about the consumer, potentially that could create a sell-off in the market.
How widespread were the signs of that slowdown? I saw those same earnings reports, and some indicated a slowdown, others did not.
Yes. Well, I think that, we saw this with Home Depot, we saw this with Starbucks, we saw this with Chipotle, and I think we are seeing it both on the high end and on the lower end as well. So I think that investors do need to be cautious over here because we are also entering historically one of the weakest periods of the year. September, we know about the September effect. And a lot of investors are very overly concentrated in big tech right now.
Dean, just kind of broadening back out, going back a year or so, despite the inverted yield curve and all the decline in leading economic indicators, the decline in the ISMs, you've maintained this posture, which has proven correct, that the economy would keep growing. Do you still see signs that there is enough to keep this expansion going? And what does that mean? This very different economic cycle then, where we have to take all of those into account, and yet they don't tell us what they once did.
Yeah, I think that we are going to see continued growth here. That is our view. And there's a few reasons for that. One is that despite the reports you're hearing from some of the consumer companies, a lot of that is because inflation's coming down, which is precisely what the Fed wanted to happen. So that means less pricing power, in particular for companies that sell goods to consumers. The volume growth on real consumer spending is actually pretty good. It's 2 to 2.5%, and that's good enough to keep the economy growing at a pace somewhere in that 2.5% range in our view. So I think that this is not inconsistent with what you're hearing. It's just a very different environment from the very rapid inflation that we saw over the last couple of years.
Aadil, you point out that one of the things that concerns you is the concentration that many people have in their portfolios, or, for example, in the S&P 500, where 3 stocks equal 20% of the index or whatever the number is. How do you know when you have too much concentration in a single stock or a single sector? A lot of people made a lot of money in NVIDIA. A lot of people made a lot of money in Eli Lilly. A lot of people made a lot of money in lots of different places. How much is too much?
Well, I think the general rule that we like to follow is not more than 5% in any one stock, right? And we all saw what happened with Tesla, right? Tesla had a monster rally up until November of 2021. And since then, the stock is down more than 40%. Right now, if we add back Alphabet and Meta, the S&P 500, 40% of it almost is in technology. So on the way up, concentration works, but on the way down, it can be very dangerous. So at this point in time, we really feel that investors should focus on increasing the breadth in the portfolio and focus on sectors that are going to benefit more from rate cuts that have been lagging thus far.
Yeah, I guess, to build on the rate cut thing, what are you expecting now in terms of cuts? The 2 that are priced in between now and next year, or actually 2 points worth?
Yes, I think probably that's what we are going to get, and the market has probably factored that in. When we do get the rate cuts, I think certain sectors will benefit tremendously from it. I think dividend-paying companies, for example, will do really well because there's near $6 trillion that's sitting in money market funds. And these yield-hungry investors, once rates are cut, need to gravitate somewhere. So they'll gravitate towards dividend payers in our view. For example, if you look at Pfizer, that stock year to date is pretty much flat. but the dividend yield on that is about 5.8%. So those are the areas of the market that we are now more interested in.